All right, people, in this Excel exercise, we're going to practice capital budgeting and risk valuation. So this is a setup, which is exactly from the chapter's PowerPoint. And you are going to create a capital budgeting table based on the information here, and then answer all the questions here. And you're going to calculate the net present value, profitability index, internal rate of return, so on and so forth. And then you are going to conduct a sensitivity analysis by generating a picture like this. Okay, that's a picture, but you're going to use the Excel charting function to get this chart. And then you are going to conduct a scenario analysis, and this is on a different spreadsheet. So basically, you're going to have different scenarios from the original setting. You have a best and the worst as additional cases. And then you're going to calculate NPVs under each case, and then get the expected NPV and a standard deviation of NPV. That's a scenario analysis. And the last one is actually easier. You are going to change the depreciation method from a straight line. As you can see right now, your depreciation is a straight line here. And then you're going to change it to MACRS, Modified Accelerated Cost Recovery System, which means each year there is a fixed amount of a percentage for depreciation expense. And then you're going to recalculate everything and get all these criteria ready. It seems like a lot of work, but don't worry, this is the easiest part because all you need to do here is copy and paste, and then with some minor adjustment. All right, so to start over, so let me just zoom in a little bit. I have put all the items here for you guys to fill in. So if you read the paragraph, we got a company considering a project and require the purchase of a new equipment at 1.5 million. So cost of equipment here, you can just put a $1.5 million. All right, and then it also says it has a depreciation of a straight line to a zero ending book value. So the ending book value here would be 0. All right, and it has 5 years. So let me just put number 5. All right, and the annual sales here is $950,000. So let me just put that numbers in here. 950,000. You are also given $100,000 of fixed cost, and 40% of the annual sales would be the variable cost. Okay, so fixed cost is 100,000, and the variable cost would be 40% of the annual sales. And that's a 40%, by the way, just to put 40% there. And also, as you can see now, you're given the cost of equipment or the depreciation base. And then you also have a depreciation method, which is a straight line, the ending book value. Based on these 3 numbers, 1, 2, 3, you can calculate the annual depreciation, which is the beginning value minus ending book value divided by the number of years. Okay, so each year the machine got depreciated, got a value deduction by $300,000. That's the depreciation expense of each year. All right, now let's keep reading. And at the end of the project, which means 5 years later, the company is going to sell the equipment for 20% of its original value. So that is a market price for the machine. On the book, the company recorded as 0, but actually the company is going to sell at a higher price, and that is the actual average value, which is 20% of the cost of equipment. Okay, that's another 300,000. And then it also tells you that the new net working capital equals to 10% of the following year's sales. So this is 10% of the following year's sales. And the required rate of return here is 12%. All right, the tax rate is 25%. And I have already put all the format for you guys for different sales. in this data area, so you don't have to be worried about the formatting of these numbers. Okay, so the next job for you is to create a capital budgeting table. All right, so how exactly are we going to do that? So number one is the year number. So you have a year 0, 1, 2, 3, 4, 5, 6, 7, 8, all the way to 10. No, you gotta create up to year 5 because this project lasts for only 5 years. All right, let me zoom out a little bit. So that's your year number. And you're gonna start with the initial investment, which is a negative input, so that equals to negative the cost of equipment. So that means at year 0, you're going to invest $1.5 million, and then you expect to operate based on this investment and make some money back. All right, so that's the initial investment. And then you're going to input annual sales, which is a constant at $950,000. Okay, just to make them a link to each other. All right, so 950,000. And for year 2, it's the same as the previous year, year 1, and then I just drag it all the way to the last. Okay, so each year the sales is the same as the previous year sales. Then for the first year sales, I just use the data here. After you have the sales, you can calculate the variable cost and fixed cost. Variable cost basically is a cost of goods sold, which varies according to the unit of the sales, and that is a fixed percentage of the sales amount, and I will lock this percentage 40%, all right? Because when I drag it all the way to the right, I don't want this sale to be shifted, okay? So I need to lock it. The 40% multiplied by the annual sales in the same year, then you'll drag it all the way. And the fixed cost is always 100,000. It's like sellings and expenses, administrative expenses, and so on, okay? Or rent, which does not change over the time. So fix it and then drag it. If you don't fix it, then it won't stay at 100,000. All right, and the next expense I want to deduct is a depreciation. Since I have already calculated the depreciation amount, so I just need to borrow the number here. And again, I need to fix it. Okay, did I fix it? Yes. So F4, hit it, or just manually put in the dollar signs to fix the cell, and then you drag it. All right, now you can calculate the earning before interest and taxes. Okay, so just use the annual sales minus the summation of a fixed variable cost and the depreciation expenses. So all 3 types of expenses will be deducted. Okay, and right here, the instruction also tells you there's no interest payment, which means you don't have to deduct interest, but you do have to deduct taxes. There are 2 things you cannot avoid in your life. One is death, another is tax. All right, the tax rate is 25%, so you're gonna use the 25% right here. Make sure you lock it, hit the hotkey F4, times the earning before interest and taxes. All right, so that's the tax amount you're gonna pay, and there's no interest deducted. Then you're gonna have net income. All right, so that's the juicy part of income statement, which is operating income minus taxes. And this net income belongs to shareholders. The shareholders can either use it as a dividend payment or just to save it as part of the equity investment. Okay, and then to get operating cash flow, which happens each year on an annual basis, you need to add depreciation back to the net income. Since the depreciation you deducted in the first place is a non-cash item, If you subtract it, you need to add it back. Therefore, the result could be 100% pure cash. All right, then you drag it. So that's the second component for free cash flow capitalization, or the capital budgeting component. Oops. Okay, so this is the first component, initial investment. The second one is operating cash flows occurring on an annual basis. And then we need to work on the next one, which is net working capital. Okay, if you read the instruction here, the net working capital, let me zoom in a little bit. The net working capital equals to 10% of a following year's sales will be required to support the project. Okay, so the net working capital is 10% of the following year's sales. So your sales start in year 1, which means you need to prepare net working capital in year 0. And net working capital basically is the inventories, is the account receivable, the cash, and a lot of short-term assets. All right, so that's a 10%, which is given. All right, you're gonna lock it before you drag it. Okay, times the sales in the next year. Okay, then just to drag it all the way. If you reach to year 5, actually the value here is 0 because you have no sales in the year 6, and you don't need to prepare any inventory here, and your inventory will be 0 in the last year. Okay, you can put this way, or you can just type in 0. It does not matter. All right, what we really want to do here is to get the cash flow from the change of net working capital. All right, so the cash flow effect from change of net working capital. All right, here from a 0 inventory or net working capital to 95,000 net working capital, how much cash is spent? All right, it's definitely 0 minus the net working capital in year 0. Okay, so that means you're gonna spend $95,000 to build up the inventory today. All right, so that's the cash flow effect from net working capital. And then you probably need to wonder, what about next year? Do I need to spend additional cash for the net working capital, or just use the inventory, which is more straightforward to understand? Well, the answer is no. Okay, so you're gonna start with 95,000 and you end with 95,000. So there's a 0 change from net working capital. All right, so you don't need to spend more cash or receive any cash. And then it has been $95,000 save level for all the net working capital for the next 3 years. So there's no cash flow effect from the change of net working capital or inventory. But in the last year, you have 0 at the end of a 5th year. You have a 0 inventory or net working capital. And before that, you have 95, which means you'll literally sell off all the inventories here, sell all of them, and then get the cash. So you have a positive inflow of the cash flows, because at the very end, you liquidate all your inventories, you sell off all your short-term assets, or you collect all your bills, and then you get all the cash back. Okay, if you read the paragraph, it also says that all the new net working capital will be recouped at the end of the project. Okay, it will be recouped at the end of the project. So you have some cash spent to build the inventory here, and then at the end of the project, we will sell off everything. The cash comes back. Okay, it's recouped because you sell off all the inventories and other short-term assets. Well, of course, the net working capital, like inventory, keep replacing all the time. You sell your inventory or you use inventory and you keep buying more inventory or build more inventory. You do this on and on multiple times in a month or in a year. If there's more inventory built up, it's actually cost goods sold. It's going to be put in here according to accounting method. Okay, but for the cash flow effect, we only look at the level of inventory, okay, to see whether it changes or not. If the inventory goes up, that means we're gonna spend cash for it. If the inventory goes down, that means we're gonna receive cash from it. Okay, so this is the third component, cash flow from the change of net working capital. The last one would be the terminal value. So you have a salvage value here. You sell the machine for 20% of its original cost. So of course you're gonna receive that $300,000 salvage value, which is 20% of the 1.5 million. You gotta definitely receive that as a cash payment, and you also gonna pay capital gains tax. Okay, capital gains tax. How much do you report to the IRS for the ending book value? 0. Okay, you report to the IRS that this machine will be worthless, will be worth a scratch after 5 years of use. However, you're gonna sell it for $300,000. The IRS will not let you go. They're gonna charge you capital gains tax. So how much money do you make here? You make $300,000 upon the reported book value of a 0. All right, and that part is subject to tax. And you're gonna multiply the tax rate here. So that's $70,000. Okay. Well, the thing is, the salvage cash flow here, this will be paid. All right, and I will change this. Okay, I will change it as a terminal cash flow or salvage cash flow, and this will be the capital gains tax paid plus the I will use the salvage value received from selling the machine minus the capital gains tax. All right, so that's the formula for it, and that's the fourth component. And then I will put up a borderline here. Okay, so now I got all the 4 components of a free cash flow. So free cash flow here, and I will sum them up. Initial investment plus the operating cash flow. If it is missing, then it will be recorded as 0. Don't worry about it. And then cash flow from change of net working capital, then salvage cash flow. I add all these 4 components together and then drag it all the way to year 5. And this is my streamline of the free cash flow. This is the finalized number to calculate the NPV, IRR, and stuff. Well, is this a project acceptable? You're gonna calculate all these investment criteria to make the conclusion. The first one here is net present value. So you're gonna use the NPV function of Excel, and the discount rate here is the required return of 12%. All right, so that must be your cost of capital, 12%. Then you're gonna put in all the cash flows from the first year to the 5th year. All right, it does not start from year 0, start from year 1. As you can see, the hint is telling you to go with the value 1 first. And what about the value 0? It's gonna be added outside the NPV function. So you're gonna add it after the NPV parenthesis is closed. So this is your NPV. All right, so that basically means the project will make a value to you or a net profit to you of $127,000 plus. The next one is profitability index. you are again going to use the NPV function of Excel, and you are going to again to use the same required return and the same cash flows from year 1 to year 5. But instead of adding the first year 0 cash flow, you're gonna use it as a denominator here. And definitely you're gonna take the absolute value of the whole thing because the denominator is a negative number, all right? And you want the profitability index to be a positive number. Okay, so the profitability index is a 1.08. That means the money you make in the future, even accounting for the risk and time value of money, is still over the initial investment. So you can still have some room to make money because this value is greater than 1. And for internal rate of return here, that's a really piece of a cake. Just use the IRR function of Excel. Then inside the parentheses, you just select all the cash flows, and this time start with year 0. Okay, if there's not a year 0 negative number, then the IRR function will not work. Then you hit enter, you can see that the IRR here is the 14.9%. That means on average each year, this project will get you 14.9%, roughly 15% as a return. And this return is higher than the required return based on your cost of capital. If you pay the bank 12% each year and you can make the money with 15% each year, that's a good deal for you. All right, the next one is a modified IRR. In modified IRR, you are going to use this MIRR function. And again, you're gonna select all the values here, all the cash flows as what you did with the regular IRR. And for the finance rate, it is a 12%. Okay, that's gonna be used for discounting all the cash flows. And the difference between regular IRR and modified MIRR is the reinvestment rate. In the regular IRR, you assume to reinvest this cash flows within year 1, year 2, year 3 with 15% IRR rate. However, that's not realistic. A more realistic reinvestment rate would just be the required return. You get the money you borrow the money and pay 12%. If you make some money and deposit the money and save the money, you also get 12%. So the 12% reinvestment rate is consistent with the market rate, and that is the reinvestment rate we use here. Okay, hit enter. And you can see because the reinvestment rate is lowered from a 15% to 12%, then the modified IRR is also lowered. All right, to get the payback period, we're going to do something extra, meaning we're gonna calculate the cumulative cash flow here. All right, and then try to get the balance of each year, and then get the amount of years that this investment will be paid off. So for year 0, at the start, that's your cumulative cash flow. That's your balance. You are in debt or in deficit of $1.595 million. And then after the first year, your balance is definitely reduced because you make some earnings here. So your cumulative cash flow or end of year balance is the previous balance plus the money you make in the new year. All right. And I will just keep dragging it all the way to the last number. As you can see, after the third year before the end of the fourth year, the balance turned from a negative to a positive. Okay, from a deficit to a surplus. So that means as years goes by, when you make money year by year, the balance is keep being reduced gradually until the deficit disappears and the surplus emerges. Okay, so how do you calculate the payback period? It equals to 3 because after 3 years, the balance is paid off, plus a fractional part of the fourth year. So you are going to use the residual balance or the residual deficit divided by the money you make in the next year to get the fractional part of the payback period. And be careful, this number is a negative, so you are going to take the absolute value of the fraction. All right, otherwise it's going to be a negative ratio. And then the number you get here is a 3.73 years. So 3.73 years, meaning that it's going to take 3.73 years to pay back the initial investment of $1.595 million. Okay. So the next job here is to get the discount payback period. And to get the discount payback period, you need to get the discount free cash flow here. So for each year, the cash flow will be discounted at the 12% rate. Okay, the 12% rate. And I'm going to lock this denominator 12% and then raise to the power of the year number up there. Okay, and just a format painter, make it a dollar figure. Then I will drag it all the way to the last year. As you can see, for the year one's free cash flow, it discounted by 12% for 1 year. The exponent is 1. And for year 2, the exponent is 2. And I'm still using the same discount rate because I lock it before I drag it. All right. And then I'm going to take another cumulative cash flow, but this time at discount level. Okay, discount cash flow. So it is the original investment for year 0, and then for each additional year, I will add the money I make at the discount level to the previous balance. All right, and then I will drag it all the way to the last year. You see, because of the time value of money, because of the discount, all the cash flows are shrinked to a lower value. All right, so that means it's going to take longer for me to pay off the original deficit. All right, so in this new area of data, you can see that it is after the 4th year, before the 5th year, your money is paid off. All right, that's where your balance changed from a deficit situation to a surplus situation. And to get the discounted payback period, it equals to 4. Number 4 is an integral part because it has already taken full 4 years to pay off the original debt. All right, plus a fractional part of the 5th year. And how do you get the fractional part of the 5th year? It is the ending balance or the deficit at the end of the 4th year divided by the money you make in the 5th year at discount level, of course. And be careful, you're going to put the thing in a set of absolute value, because if you don't put an absolute value, the number is going to turn out as negative, and you want the ratio to be a positive number. Okay, that's a 4.7. So if you count for the time value of money, you're going to discount all the future cash flows, then it's going to take longer to get your money back. All right, so the result will be a longer time for paying back. All right, you can also just format this two cells, right click format, and for the numbers, and you can just put a quotation sign there and then space days. All right, because that's the correct format for payback period. Some of them are expressed in dollar figures like NPV. Some of them are in a percentage, and some of it will be in number of days. And for profitability index, it's actually a ratio. It should not put it as a dollar figure, so I just use it as general number here. And you can right click on this number, do format cells, and then go to custom, and you can see the number here should add a word, and it's actually just a letter of x, space x. And x basically means the number of times. 1.08x means the money you make in the years following the investment is 1.08 times of the initial investment. So that's a surplus. You are making money. It's just as consistent with what we have learned in the financial ratio chapter. And the next one, actually, I want to work on the last one. If the depreciation method changed to a modified accelerated cost recovery system, MACRS, please repeat the same thing what we did in step A. Okay? As I promised, it's pretty easy to do. You just need to copy paste the numbers here. So for example, right here, you're gonna copy paste all the numbers. All right, copy, and then you can paste here. But I highly recommend you to create a new spreadsheet. Paste. All right, copy paste. Control C for copy, Control V for paste. Okay, as you can see, the same result would be replicated in a new spreadsheet. Same answer, same calculation. So if you do copy paste, you don't do anything funny, all right? So if I just copy this and just directly paste it, okay? Just directly paste it. Don't do anything special like paste the numbers only or formulas only or the format only. Don't do that. Okay, just do Control V, right? Just do Control V, so everything would be retained. Okay. All right, so you're gonna calculate the whole thing based on a different depreciation method. Right now, the depreciation method in this setting is a straight line, so you can see that depreciation is the same for all the 5 years, and you're gonna put the MACRS method. If you use MACRS method, there's no annual depreciation. There's no annual depreciation at a fixed amount. Okay, I'm gonna delete this part. And for the ending book value, we're gonna recalculate it. Okay, we're gonna recalculate it. And one thing I want you guys to do here is to insert, okay, insert a blank row here. You're gonna select all the cells. Then you right click on it, you're gonna do insert, okay, and shift cells down. And this new blank cell will provide you the data of MACRS percentage. As you can see, I have put all the percentage here from year 1 to year 6, okay, from year 1 to year 6. Okay, move back to this sheet, and it's not from year 0, it's from year 1 because the depreciation only incurs after 1 year. All right, so these are all the percentage. Why do I have some value for year 6? You know, that percentage is not actually depreciated, it's not actually incurred. This 5.75% is the ending book value percentage. All right, so how do you calculate the ending book value? It equals to this last number in your depreciation data times the cost of equipment. Okay, dollar figure, decrease decimal. So, and all these numbers here are given by the IRS. The government provides this number to you, so you have some thing to hold on to calculate the annual depreciation. All right, and then you're going to report to the IRS and tell them that based on their method, you're going to report ending book value of this much. Okay, and you can see that all of them would add up to 100% if I put the summation of all the numbers. They all add up to 100%, which is the full value of the cost of equipment. Okay, and how do you calculate the depreciation for each period? So once again, you're gonna use the cost of equipment as the base value, and you're gonna multiply the depreciation percentage assigned by the government, okay, which is a given number, and and that's your depreciation for the first year. And then you're gonna drag it all the way to the right. Before you drag it, you must lock B1 here, and B1 stands for the cost of equipment. So if you drag it, then the cost of equipment of $1.5 million will be used for all of these sales. Okay, you can see that for each of these depreciation, you use the cost of equipment times different percentage. Okay, it's the same cost of equipment there. And basically that's it. So the only thing changed here is the depreciation you used. Okay, once you change the depreciation method. And also another thing changed here is operating cash flow. You're gonna add the depreciation back to net income, so you're gonna use it one more time. And the last thing that got changed is your salvage cash flow. Okay, because the ending book value is not zero anymore from the first case. According to the IRS, with the MACR method, you're gonna report the ending book value as this number, not zero anymore. Then you gotta make less capital gains when you sell the machine for 300 grand, because you have some book values to deduct from. So you are making $214,000 capital gains instead of a full $300,000 capital gains, and your tax on capital gains would be less. All right, because your capital gains is less, and you must by now have learned how to calculate capital gains. That's the money you actually sell at minus the book value of it. Okay, so that's another number changed because this ending book value got changed. All right, for question B, we're going to conduct a sensitivity analysis. In particular, we're going to look at the NPV in response to the change of different variables. So we have two variables in this case. If you write down here, when I move the thing down here, you have a change of a sales and also change of a fixed cost. So these are the two components that determines the NPV. You see sales is here, fixed cost is here. If I change any value of them, so let me first mark them, the NPV would change. All right, so let's say if I change it to just add $1 million here, you will see my NPV would change by a lot. Then undo it. And for fixed cost, if you change to 200,000, that's also gonna change my NPV. All right. So in this practice, we are going to create the chart. The picture I give it to you is right here. Okay, we are going to create a chart like this. It's called an NPV sensitivity analysis, and the two variables are used here. The X value is the percentage change of the variable. The Y value is the NPV level. And you are going to best use the data table function of Excel. If not, then you would have to do all of this one by one. For example, what about if a sale decreased by 30%? So you're gonna change the sales to a different number, lower than that by 30%. Then you're gonna record the NPV. Then you change the sales by another negative 10%. Then you're gonna record the NPV again, on and on. You're gonna repeat it 5 times for one variable, another 5 times for a different variable. All right, that's just too much work if we do it manually. So what you can do is to use the data tables function, and this is under data what if analysis. You will see the data table right here. Before we do that, there's some setup we need to do. For example, I'm going to put a value 0 here. Okay, 0 is 0% next to the annual sales, and I'm going to do the same thing for my second variable for sensitivity analysis. It's like this. All right, and then for the annual sales, right here it is a given number. I want to change it to that number, $950,000, to the same value multiplied by 1 plus this given percentage. Okay, just take a look at this formula. So the meaning of this is that if I change this number from 0% to negative 30%, you can see that the NPV would change accordingly. If I change it to 30% right here, and I also have a different NPV. All right, and I'm gonna do the same thing. I will change my fixed cost from 100,000 to 100,000 times 1 plus this percentage. So right now it's set at 0%. If I change it to 10%, then you can see the fixed cost increase by 10% and the NPV decrease. If it's a negative 30%, then you will see my fixed cost got reduced and my NPV actually got increased. All right, so let me recoup the setting. All of them are set as 0%, and all of the two variables incorporate this information of percentage. And then we will conduct the sensitivity analysis. For example, the change of sales. I want the percentage here. Each of the percentage would yield a different NPV value here. All right, I have 5 changes, and each of the 5 numbers will be replaced. Will be used to replace this 0 percentage. All right, and then I will record the corresponding NPV. And before I do that, I need to move this NPV, all right, to a different location. I will do cut, Control X, and then Control V. All right, and right here, I will make it equal to the NPV value. I have it right now. Okay, equal to the NPV value, and everything here is calculated in percentage. And they are all based on the value. All right. Okay, and now I can feel safe to do the data table. I will select the entire thing, okay, from this NPV definitely. I definitely want to incorporate this value because all the 5 blank cells will show up the NPV based on the formula here. And then I will go to data, make sure it is what if analysis, and I will hit data table. And I just need to click one more time, which is 0%. It is going to be the row input cells because all these percentage are in a row, and these numbers will be used to replace 0% here. These 5 numbers, 5 percentages are not in column, they're in a row, and they are used to place this 0%. So I click on that, and then I hit OK. You can see that the Excel will automatically compute the corresponding NPVs under different cases. And make sure these are in dollar figure. All right, and I'm gonna do the same thing for the next variable, which is the fixed cost. So again, data, what if analysis, data table, and each of the 5 numbers on the top will be used to replace the 0% here. So I can have a different value of NPV 5 times in a row. So these are the corresponding NPVs. All right, make sure all of these are in dollar figure with no decimal. Okay, so this is something we have replicate, and I want you guys to create the picture or the chart. So you're gonna select the data area here. So the first row here is about percentage change of the variable. The second row is the corresponding NPV, and you're gonna hit insert. Okay, insert. You're gonna look for the chart options, and you're gonna select this chart, the scatter chart with the straight lines and the markers. Okay, so this is the base of the chart, and I want you guys to right click on it, right click on the chart and hit select data, and you have one series of data here. I want you to edit a little bit. The name of it is the percentage change of sales. The X values and the Y values, do not change them. One is for the percentage and another is NPV. Okay. And then I want you to add another series. Okay. Add, and the name of it is called a change of a fixed cost. The percentage is the X value. The NPVs, the corresponding NPVs are the Y values. All right, so this is the look of the scatter. Okay, and I can just enlarge it a little bit. And if I hit this chart, you will see some options show up. I want to do a quick layout, and I want to hit the top left one. All right, the chart title is about sensitivity analysis, NPV sensitivity. All right, and the y-axis is the NPV value, and the x-axis is about the percentage change of a variable. Okay, and I'm going to enlarge it a little bit, and I will put this part, it's called a legend, down the bottom. So I will do a right click on this part, format legend, and I will put down the bottom to make it look a little nicer here. All right, so this chart is created, and that's a sensitivity analysis. And what's the point? Well, by comparing these two variables in this sensitivity chart, we will know which variable is more important in terms of influencing the NPV. As you can see, the slope of the blue line or blue curve is steeper. So that means for the same amount of percentage change of the variable of the sales, by the way, the NPV would change by more. All right, so NPV is more sensitive to the change of a sales than to the change of a fixed cost. All right, so the blue line is the change of the sales. It's a steeper, so that means for the same amount of value change in X, the Y value is going to change by more. So that means the NPV is more sensitive to change of a sales than to change of a fixed cost. So the change of fixed cost is this orange line. All right. So if we have to give up one of the variable, then we should give up the change of a fixed cost because it is less important compared to the sales. If we want to focus on something, definitely the sales should be our priority. We want to increase our sales so we could have a more profit and more NPV generated. All right. And if you are doing a orthodox NPV analysis, you would do like 6 variables altogether. But here, for study purposes, I just let you do 2 variables. And also, you need to calculate the sensitivity here. All right, the sensitivity is very easy to calculate. You're gonna use the slope function, and the y's would be the the NPVs. The x values would be the percentage change. Okay, and then you hit enter. So this is the sensitivity. So this is basically telling us if, all right, if the x variable changed by 1, all right, or 100%, then the NPV, the y variable, will change by 1.5 million. All right, that sounds a little bit too big. Let me divide it by 100. Okay, now it makes a little more sense. So 14,999 or 15 grand is the value for sensitivity. That basically means if sales change by 1%, okay, that's why I divided by 100. If the sales change by 1%, then NPV will change by 15 grand, okay, 15K. So that's how we interpret the number of sensitivity. Okay, and of course, they're going to change to the same direction. As you can see, this value is a positive. All right, and for fixed cost, the sensitivity of it, I'm going to use, again, the slope function And the y values would be the NPVs in this table. The x value would be the percentage changes. All right, and I still need to divide it by 100 to interpret it on the 1% level instead of a number 1, because number 1 is 100%. All right, so if I want to interpret that with the 1% level, then I have to divide the whole thing by 100. So that's the value here. So I'm going to dollarize it and reduce the decimal. So it's telling me that if the fixed cost increased by 1%, then the NPV will decrease by $2,704. Okay, they go to the different direction because this sensitivity value is negative. Okay, the next exercise of this practice is to calculate the NPVs under different scenarios. So that's question C. So you are provided with several scenarios. You have a best, worst, and a base case. And each scenario takes certain likelihood to happen. So the probability for best is 20, for base is 60, worst is 20. So add it all together, that's 100%. So that basically covers all possibilities. And under each case, you would have a different level for price, for sales, for fixed cost, and also for cost of capital. And you are going to calculate the NPV under each case, and then you're going to perform the expected value of NPV and the standard deviation of NPV, so on and so forth. All right. I think the best way to do this is to use a scenario analysis of Excel. Here is your work zone. So let me just delete all this instruction here because I remember it. So that's sensitivity analysis. So this is your original setting. So you're going to change two things, actually three things. One is the percentage change of annual sales. That's what we did previously. Okay. And another is a percentage change of a fixed cost. And the last one is the required rate of return or cost of capital. Okay. And you're going to observe the NPV output. Okay. And you have three cases, so you're going to obtain three NPVs. Let me just change the name of it. So you can see right here, when I click on it, here is a volume bar, and this is the name bar. I want to hit this name bar right now. It's named as a C2, column C, row 2. And I want to name it as percentage change of sales. All right, then hit enter. It doesn't let me. It's because I can't use a space sign. I have to use underscore change of sales. Now we're talking. Okay, and for this one, I want to name it as a change underscore of fixed cost. Don't forget to use underscore. And for this one, I want to name it as cost of capital. Don't forget to use underscore instead of a space. And for NPV, this cell, I want to name it as NPV. That's it. Okay. So now, as you can see, I have placed the name for these four cells. And then let me conduct my scenario analysis. So I need to hit data, and I need to go to what if analysis, and I will go scenario manager. Okay, I will have three scenarios. The first one is the best case. Okay, and I'm going to change these three cells. Okay, you can see that C2, C5, and B8. These are change of sales, change of fixed cost, and required rate of return. Okay, and then I will hit OK to define that. Under the best case, the change of sales, let's see, positive 10%. All right, and the change of a fixed cost is a negative 15%. So you have more sales and less cost, so that's good. And your cost of capital would be 8%. All right, it's lower than the original 12%. It's also better. So that's how I define the best case. And then I add the base case. Still, I will change the same sales. So these sales are change of a sales, and here is a 0, and a change of a fixed cost is 0. So just to maintain the original value, cost of a capital is still 12% or 0.12. So I don't do anything for the base value. And then I do for the worst case. Okay, worst case, still change the same sales, and the change of the sales is negative 8%. All right, that's worse. And the fixed cost increased by 15%. It also make it worse. The cost of capital, instead of a 12%, now it's 20%. So that's my definition of the 3 scenarios: best, base, and the worst. And then I will summarize the result, and I will observe the project NPV right here, and then hit OK. Okay, so the Excel automatically generates the corresponding NPV for each of the cases. So the best case, base case, and the worst case. As you can see, the NPV is the highest for the best and the lowest for the worst. And I will do some trimming work here. I will delete the unnecessary sales. Okay. And also it has a certain grouping function. It's called I just ungroup them. Okay, ungroup everything. All right. So this is my scenario table. Okay, and right here, I'm going to delete these cells also. All right, and for the current value, I don't need that. It's just my base case. If I don't delete it, you see I have the same NPV as what I have here. Okay, and then I need to input the probability. For the best case, that's a 20%. For the base case, that's a 60%. And for the worst case, that's a 20% likelihood of occurrence. All right, and then I'm going to calculate the expected NPV. How to get expected NPV? You are going to use the probability multiplied by the NPV under each case. Then you add them up. Okay, you're gonna add up all the 3 products together to get the expected NPV. Okay. So you have an NPV times probability, then you get 1 product. You do it for 3 cases, and you add 3 products together. So that's your expected NPV, decreased decimal. And you can also use this function. It's called a sum of product function. And you're going to use 1 vector of numbers, which is your NPV, multiplied by another vector of numbers, which is your probability. Okay. To close it, you don't want to hit enter only. You want to hit Control Shift Enter. Okay, Control Shift Enter, and that's gonna give you the same result. And I think this is easy. This way, you don't have a lot of numbers to click. So you just select 2 areas and make the product, and then Control Shift Enter. Okay, so Control plus Shift plus Enter instead of enter only. All right, so that's for expected NPV. And then I want to calculate the standard deviation of an NPV, or the risk of an NPV. And this is going to take a little skill here. And this is a scenario-based standard deviation. It is not like historical return, like a Tesla stock from 2013 to 2022. It's actually, this case is a scenario-based calculation. And each case has different probability of occurrence. All right, and I tell you that there's no one Excel formula that can directly give you the result here, and we have to do this step by step. All right, So the first step to do it is to get the deviation of each case. So for the best case, then you wouldn't need to use its NPV minus the expected NPV, and you are going to log the expected NPV. All right, it's called a deviation, and then you're gonna drag it all the way to the right. So each of the NPV under each case is subtracted by the expected NPV. All right, and then the next one is called a squared deviation. All right, so you're gonna take the square of it. Okay, exponent is 2, and that's gonna be a lot of numbers. Oh, sorry, wrong cell. And then you're gonna drag it all the way. All right, and then you're gonna calculate the variance. Well, before do the variance, you need to use the probability times the squared deviation. All right, so you're gonna use a probability here multiplied by the squared deviation. Then you drag it. Okay, and then you calculate the variance, which is a summation of the 3. Okay, and these are probability times squared deviation. And how do you get the standard deviation here? Then you just need to use a square root of the variance. You just calculate it. All right, I'm doing this following exactly the mathematical formula for standard deviation. Okay, so this is your standard deviation. It's a pretty high. It's at $222,000 plus. Okay, so this is the result. And I can also calculate standard deviation of NPV by using one line of Excel formula. Okay, just one line. Instead of creating extra 4 rows, I just use one formula here. Okay, and that's still gonna require me to follow the standard deviation formula. So what I do here is I use a square root of variance. And how do I calculate the variance? It's a summation of all the probabilities here times all the squared deviation. Okay, all the squared deviation. So it's going to be each NPV. Okay, I'm going to select all of them. Each of them will be subtracted by the expected NPV. All right, and this is called a deviation. I need to circle it, close it, and then raise to the power of 2. So this part is a deviation inside the parentheses, and this part is a squared deviation. All right, and I'm gonna do this for each of the cases, for each of the column here. Okay, oops. And then I will close the parentheses again and again. All right, since this calculation involves vectors of numbers, as you can see, I select the probability vector and also the NPV vector. So what should I do to close it? That's right, I need to hit Control Shift Enter instead of just Enter. Okay, Control Shift Enter. Then this is my result. Format Painter. Okay, so you will see that with one Excel formula in one cell, I can still get the standard deviation, but that's going to require me to use a Control Shift Enter, just like the expected NPV up there. Okay, so in your calculation, you're gonna find out all of these 4 numbers. So it's a expected NPV and a standard deviation of NPV, both methods. Okay, so 2 methods for each.